Universal life is a type of permanent insurance where you, as the insured, are taking on the risk of interest rates. Interest rates in terms of how much interest your cash value is credited. With a universal life policy, if interest rates are higher than what was originally forecasted when your policy was written, you can actually reduce or possibly altogether eliminate your need for premium payments. But the opposite is also true. If interest rates decline and are lower than was originally forecasted, you'll actually have to pay more in premiums to keep the policy healthy and in force. Now, one of the challenges with universal life is if you're not paying attention and interest rates drop, you could actually never be a day late or a dollar short with your premium payments and actually have your policies lapse for lack of cash value. And that's because with a universal life policy, your cash value is nibbled away at every month to provide the cost of insurance, the coverage, the pay the premiums, if you will, on the death benefit that you're receiving. Well, over time, if those withdrawals are greater than your deposits and your interest, then what happens is the cash value erodes, goes to zero, and then 30 days later, your policy lapses. That means no more coverage, even though you were never a day late or a dollar short. So it's very important with universal life insurance that you pay attention to your annual statement. By law, the insurance companies have to send you an annual statement showing what your premiums were over the year paid in, what your cash value was at the beginning of the year, and what your cash value is at the end of the year. And if your cash value is not increasing, if it's staying level or declining, well, then you have a problem. You're in what we call the downward spiral. What starts as your cash value simply level for a couple of years, then accelerates into large losses of cash value, ever increasing losses from year to year. This downward spiral will erode your cash value down to zero. And once your cash value hits zero, then 30 days later, your policy will lapse. How do you know if you're in this situation? Well, you need to look at your annual statements and see whether or not your cash value is increasing from one year to the next. If it is increasing, you're probably fine. If it's not increasing, and even if it's simply staying level, well, then you do have this problem of what we call the downward spiral. And you need to talk to the insurance company, you need to talk to your agent, or you need to talk to us. You can always give us a call and we can take a look at it for you and share with you the solutions on how to fix the downward spiral. I think one of the easiest ways to understand this is to use a line graph to help visualize what's going on here. Over time, your premiums are scheduled and they're scheduled not to change. And you have a death benefit or dollar access as well. On day one of the policy, you've got zero cash value and the death benefit. The entire difference between the two is how much the insurance company has at risk, and they charge you a fee, a cost of insurance to cover that risk. Now, over time, as premiums get added to the policy, the cash value is scheduled to increase. The death benefit, however, stays level. What's that doing is over time it is shrinking the amount at risk that the insurance company bears. This is necessary in a life insurance policy because every year older you get, the cost of coverage actually increases. Think about it like this. Buying a term life policy for 1 year on a 1-year-old for, let's say, $10,000 in coverage is cheaper than buying a 1-year term policy on a 100-year-old for $10,000. So it's a lot cheaper to insure a younger person than an older person given the same amount of coverage or the same amount of death benefit. So over time, the cash value needs to grow, shrinking that risk proportionate to how the cost per thousand goes up. So while the one piece is getting more expensive, the other piece is getting smaller and they offset each other. Where folks get into trouble with the universal life, the variable universal life, and the indexed universal life is when the cash value is growing behind schedule, the internal costs are building up and begin to overwhelm the deposits that you're making as well as the interest that you're making on those deposits. In the beginning, it just levels off where the deposits and the withdrawals equal each other. But then because every year it's a little bit more expensive to buy the same amount of coverage on a person, it then begins to increase the costs, digging into the cash value, digging into the principal, if you will. And once you start to dig into principal, it goes faster each year because each year you're receiving less interest and you're having to dig into more principal. So that's where the analogy of the downward spiral comes in, and it crashes. So that is a real problem. There's been way too many instances in my career where I've met folks who are in that process where all of this money they've put into life insurance for many, many years is going to be for naught unless they take some corrective action immediately. So what kind of corrective actions can you take? Well, there's a combination of different things that you can do. You can simply pay more, which puts greater deposits into the cash value, which will then increase the cash value, thereby shrinking the amount at risk to the insurance company and lowering the costs and making the policy healthy. So pay more, that's one option. A second option is you can reduce your coverage. You can reduce the amount of death benefit. By dropping down the amount of death benefit, you squish that amount that's at risk. You reduce it, thereby reducing the costs. So you could pay the same amount, but reduce the death benefit. That will fix the problem. Another thing that you could do is you could do a combination of both. You could do a reduction of death benefit and an increase in premiums. And you could do a small amount of both, which might be successful in putting you back on track to having a life insurance policy that will be there and be able to pay the death benefit at the end of your days. So those are the three different things that you can do to save a policy that is in the downward spiral. You can pay more, you can reduce the death benefit, or you can do a combination of both. If it's a bit overwhelming for you, which it can be for many folks, that's why we're here at Taylor Retirement Services to help debunk some of the mystery and some of the confusion and some of the haze put around a life insurance policy. So it's very important that at least once a year you're reviewing to make sure that the cash value is increasing in your policy.